In September 2008, the federal government didn't just rescue banks. It rescued something most Americans had never heard of, and honestly still haven't. Here's the part that textbooks tend to skip. Most of the actual destruction that fall didn't originate from your local branch bank. It came from somewhere else entirely. From money market funds, from overnight lending contracts, from structured financial vehicles with names so convoluted that the people selling them could barely explain them. It came from a system that, at its peak, held more assets than all U.S. commercial banks combined and reported to almost no one. That system didn't collapse in 2008. It was bailed out, quietly, creatively, and at a scale that most people were never shown the full invoice for. It's called the shadow banking system. It's still here. It's considerably larger now. And the gap between how much it controls and how little most people understand about it is, frankly, one of the more consequential blind spots in American economic life. Start with something simple. When you put money in a traditional bank, that money enters a heavily fortified, deeply regulated system. The bank is legally required to hold a percentage of its assets in reserve. Your deposits are insured by the FDIC up to $250,000. There are strict capital requirements, mandatory stress tests, and federal examiners who routinely show up to ask uncomfortable questions. Shadow banks don't operate under any of that. And it's worth being clear, that's not a glitch. It's a design feature. The term shadow banking was coined by economist Paul McCulley at a PIMCO investment forum in 2007, almost exactly 1 year before the system he was describing nearly took down the global economy. His definition was elegant. Any financial entity that performs bank-like functions, borrowing short, lending long, and creating credit, but does so without a bank charter, without deposit insurance, and without meaningful regulatory oversight. So who actually populates this network? Hedge funds, private equity firms, money market mutual funds, special purpose vehicles, the infamous SPVs of 2008, collateralized loan obligations, or CLOs, real estate investment trusts using massive leverage, insurance companies that have quietly drifted into credit markets, and undergirding all of it, the repo market, a mechanism so large and so essential that it processes more transactions before 9 a.m. than most people earn in a lifetime. The Financial Stability Board, the international body that monitors global financial risk, estimates the total size of the shadow banking system at approximately $63 trillion worldwide. The United States holds the largest single share of that pool. For a sense of scale, the entire annual GDP of the United States runs around $28 trillion. We are not describing a quiet corner of finance here. We are describing a parallel system more than twice the size of the entire American economy. The obvious question is, why does something like this exist? It comes down to two forces, profit and necessity. Traditional banks are expensive to run under modern regulatory constraints. Capital limits and reporting obligations create operational friction. Shadow institutions don't carry that friction. They can take on more leverage, move capital faster, and generate returns that a regulated commercial bank structurally cannot replicate. For institutional investors chasing yield, pension funds, university endowments, sovereign wealth funds, that return differential isn't just attractive. In a prolonged low-interest rate environment, it becomes a survival mechanism. And that's the uncomfortable truth underneath all of this. The shadow banking system isn't some rogue, back-alley operation running in the dark. It is the core mechanism through which an enormous portion of American retirement savings, university endowments, and public pension obligations are actively managed. It exists because the visible economy needed it to exist. Here's a reality we're sitting with. There is a very high probability that the company signing your paycheck or the company employing someone you care about is owned by a private equity firm. Private equity firms operating in the United States own portfolio companies that collectively employ more than 11 million Americans. That figure, tracked by the American Investment Council, comfortably exceeds the total civilian workforce of the entire federal government. These are not obscure niche businesses. Private equity owns hospital systems, nursing home chains, veterinary networks, local newspapers, car dealerships, fast food franchises, and a rapidly growing share of the single-family rental housing market. The economic footprint of these shadow institutions touches American daily life in ways that are rarely labeled or disclosed to the consumers experiencing them. Then there's the repo market. It doesn't come up at dinner tables, but it should. Repo, short for repurchase agreement, is, at its core, short-term overnight borrowing. One institution sells a high-quality security, like a treasury bond, to another and agrees to buy it back the very next day at a marginally higher price. That price difference is effectively the interest rate. It is how shadow institutions, and increasingly traditional banks, maintain their daily liquidity. It is the literal circulatory system of modern finance. The U.S. repo market processes between $4 and $5 trillion in transactions every single day. Not monthly, not annually, daily. And because the entire system operates on relentless 24-hour overnight cycles, a disruption that starts on a Tuesday morning can cascade through the global financial architecture by Tuesday afternoon. We know this because it very nearly happened in September 2019. Out of nowhere, repo rates suddenly spiked to 10%, roughly 10 times the normal rate, in what market insiders called a repo market seizure. The plumbing choked. The Federal Reserve had to immediately step in and inject hundreds of billions of dollars in emergency liquidity to stabilize the market. The intervention was incredibly fast, highly effective, and almost completely invisible to the general public. Now add private credit to the picture, because it is currently the fastest growing and arguably most under-scrutinized corner of shadow finance. Private credit funds, operated by massive non-bank firms like Ares Management, Blue Owl Capital, and Apollo, lend money directly to corporations, stepping into a role that traditional commercial banks once utterly dominated. But they aren't chartered banks. They aren't regulated like banks. The loans they extend do not appear on any public commercial bank balance sheet. This means they are largely invisible to the standard macro-prudential instruments regulators use to monitor the health of the financial system. The private credit market has ballooned to well over $1.7 trillion, as traditional banks pulled back from mid-sized corporate lending, partly as a direct response to stringent post-2008 regulations. Private credit simply stepped into the vacuum. The regulatory intent after the Great Recession was to make traditional banks safer. The unintended consequence was to shift the underlying risk into an opaque sector with far less visibility and far fewer safeguards. And finally, there are CLOs, collateralized loan obligations. These are vast pools of corporate loans sliced into distinct risk tranches and sold to institutional investors worldwide. The U.S. CLO market currently runs to roughly $1 trillion. The structural engineering will feel intimately familiar to anyone who spent time studying the 2008 subprime crisis, because it is functionally identical to the CDOs, collateralized debt obligations, that caused the original collapse.
Banking. Watch out for part 2 on shadow banking and all you need to know about Wall Street. Don't forget to hit the subscribe button.